The Fed utters and the market responds. Are you surprised by the magnitude of the rally of the U.S. stock market yesterday based on a couple of words from the Fed?
Yeah, it was a very subtle change where Powell's moved from patient to saying, I'll do what's needed should the economy deteriorate. So I'm a bit surprised by the sharpness of the move, but given the context of what we had in May and the very oversold conditions, I don't think it's out of the realms of what you should expect, basically. The market was worried that the Fed may not cut if we do get into a trade war and we see economic growth weaken. I think Powell's reassured the market that he is there to cut if the trade war does escalate further. And I think probably the market's gone too far right now, pricing in that next Fed cut. I don't think there will be a cut unless we do see a deterioration in trade or an upping of the ante on China-U.S. trade relations.
Was yesterday just kind of the perfect combination of the Powell put, the oversold conditions you mentioned, Patrick, a lot of sort of selling pressure coming into the day, and maybe some margin covering? Was it a short-term, maybe one-day wonder?
I think it is probably short-term because you shouldn't have a euphoric reaction to what Powell said. His words were that if needed, we'll be there. And I don't think you buy based on that because if it's needed, you don't want to be in equities. And it's difficult for me to see where the real leadership in U.S. equities are going to come from. So you might get a steepening of the curve, which we expect, which will be good news for financials. But it's not the right kind of steepening you'd want if you're a financial because the weakening of the front end means you've got a real weak economic backdrop. The technology companies that have been the leaders for recent years, you see issues with government. And it's going to be a very difficult decision on the way government treats these large cap tech companies, I think, because if you are in a trade war with China, you want strong technology companies in the United States. So you've got the two edges of the sword right now on what the U.S. government's doing on both the White House administration and Congress, maybe looking at things from different perspectives.
I think our viewers are kind of wondering, what do I do now? Okay, we had a great start to the year. May was a disaster. June, obviously, with yesterday's pop, is looking pretty good, but they wonder what to do individually. We talk a lot on this network, Patrick, about Boeing's problems. The CEO was on the other day. Are you long Airbus?
Yeah, so we're looking for ways to play a potential trade war on companies that might win in a trade war that still fit in our base case where we actually expect a trade deal eventually and continued economic growth. So we like Airbus, we don't like Boeing. We don't like Caterpillar, we like Toshiba Machinery in Japan. Basically companies that can sell into China if trade relations deteriorate with the United States, where China moves away from U.S. domiciled companies on goods that they need to import or have production on. And I think looking for regions that are outside the United States may be beneficiaries if it is a bilateral trade war where the rest of the world's not involved and it's just the U.S. and China going head-to-head on a trade war. Also, like gold from that perspective, we think a trade war happens, you get stagflationary environment, and that's toxic for bonds, that's toxic for equities. That means lower growth, higher inflation. You should see a pop from gold in that environment.
You know, you mentioned Toshiba, obviously a Japanese company. We've talked about how the Japanese market on pretty much every metric is the cheapest major developed market in the world, but investors haven't cared. It's still well down this year, Patrick. Are you betting on Japan or just betting on Toshiba?
We are betting on Japan. So that's a relatively new position for us, that we're starting to go long Japan now. And I think Germany and Japan get hit up in any news that's negative on trade. And if it ends up being a bilateral trade issue between the U.S. and China, Germany and Japan could be big beneficiaries. So it's probably right from a global growth perspective that those markets, excuse me, sell off on trade concerns. But individual companies in those markets may be beneficiaries. And as you've said, Japan's the cheapest it's been in 20 years on earnings, on EV to EBITDA, on dividend yield even. You're getting a significant dividend yield on Japanese companies right now. So I do think it's the time to be buying Japanese stocks right now.